The financial stability of a company can be tested in many ways. One of the quickest ways to see just how well a company is performing is to use financial ratios. In this lesson, you will learn what market value ratios are, how to calculate them, and how to interpret them. There are five major categories of ratio analysis, namely liquidity ratio, debt management, asset management, profitability, and market value ratios. Market value ratios are used to evaluate the current share price of a publicly held company's stock. These ratios are employed by current and potential investors to determine whether a company's shares are overpriced or underpriced. In addition, these give management an idea of what the firm's investors think of the firm's performance and future prospects. Some common ratios include earnings per share, book value per share, and price earnings. Earnings per share or EPS measures the company's net income per share of outstanding stock, indicating a company's profitability to investors. Earnings per share is generally considered to be the single most important variable in determining a share's price. It is also a major component used to calculate the price to earnings valuation ratio. The formula to get EPS is net income less preferred dividends over outstanding average shares. For example, Company A has net income of $25 million. It has preferred dividends of $1 million, outstanding shares of 10 million for the first half of the year, and 15 million for the other half of the year. To calculate EPS, we just subtract $25 million to $1 million all over the average outstanding shares of 10 million and 15 million. Thus, our earnings per share will be $1.92. This means that for each share an investor would get $1.92. When calculating, it would be more accurate to use a weighted average number of shares over the reporting term because the number of shares outstanding can change over time. Higher earnings per share is always better than a lower ratio because this means that the company is more profitable and the company has more profits to distribute to its shareholders. Although many investors don't pay much attention to this, higher earnings per share often makes the stock price of a company rise. And since so many things can manipulate this ratio, investors tend to look at it but they don't let it influence their decisions drastically. Next is book value per share or BVPS. The term book value is a company's asset minus its liabilities, and it's sometimes referred to as equity. This ratio is used to compare a firm's common shareholders' equity to the number of shares outstanding. In the case that the firm dissolves, it is the amount that the shareholders will receive. To compute for this, just divide the total common shareholders' equity by the number of common shares. For example, Company A has common shareholders' equity of $15 million and a common shares of 5 million. To get the book value per share, just divide 15 million by 5 million and we get $3. If a firm's book value per share is higher than its market value per share, then the stock is undervalued. This means that it trades lower than the price that the market determines. However, book value is not the same as the market value. The book value of owner's equity is not directly tied to the market value of a business and is essentially an accounting value subject to management discretion in accounting policies. Therefore, book value per share can determine if a stock is undervalued or overvalued, and it helps investors understand how a stock behaves. If market value is much higher than book value, the financial markets are likely experiencing a bull market. If the values are closer together, the financial markets may be in a bear market. Lastly, we have the price earnings or PE ratio. This calculates the market value of a stock relative to its earnings by comparing the market price per share by the earnings per share. In other words, the price-earnings ratio shows what the market is willing to pay for a stock based on its current earnings. For example, Company A has a stock price of $40 and an earnings per share of $8. Its PE ratio would be $40 over $8. resulting to 5 times. PE ratio is often expressed in a multiple of earnings, and as you can see, it is not expressed in a dollar terms because the dollar terms in the numerator and the denominator are cancelled out. Therefore, the higher the PE ratio, the more the market will fork over. Some investors read a high PE as an overpriced stock. That may be the case, but it can also indicate that the market has high hopes for this stock's future and has bid up the price. A low PE ratio may indicate a vote of no confidence by the market, or it could mean this is a sleeper that the market has overlooked. Known as value stocks, many investors made their fortune spotting these diamonds in the rough before the rest of the market discovered their true worth. Again, market value ratios are used to evaluate the current share price of a publicly held company's stock. These ratios are earnings per share, book value per share, and price earnings ratio.